SLV can trade at $64 even when nobody can source real silver at $64. The difference isn't volatility, it's the creation/redemption machine behind the ETF. And if that machine slows down, your silver exposure becomes something else entirely. If you own SLV, if you trade it, or if you're using it as a simple way to get silver exposure, then you need to understand one thing before anything else: the SLV price on your screen is not the same thing as silver in a vault. It only looks the same when the machine behind the ETF is working smoothly. And that machine has a name: the creation and redemption mechanism. Most people never learn how this works because in normal times, it's invisible. The ETF tracks spot, close enough, the spread is tight, and the financial media tells you, see? It's basically silver. Buy it and move on. But late 2025 is not normal. Silver is whipping around $60 to $65, physical premiums are behaving like a different market, and the one thing an ETF cannot survive is a loss of confidence in its ability to access metal on demand. So let's define the problem clearly. SLV is not a magic warehouse that passively holds silver forever while investors come and go. SLV is a tradable share system. It's a wrapper. And the only reason that wrapper trades near its underlying value, its NAV, net asset value, is because a small group of institutions, called authorized participants, are supposed to keep it honest through arbitrage. Here's the simplified version of the promise Wall Street sells you. SLV trades like silver because if shares ever get too expensive relative to the silver it holds, big institutions can create new shares by delivering silver into the trust. If shares get too cheap, they can redeem shares and pull silver out. That creation/redemption process keeps the market efficient. That is the theory. Now here's what matters in a crisis. You, the viewer, are not an authorized participant. You cannot show up with your SLV shares and demand metal. You can sell your shares to someone else, yes. You can buy more, yes. But redemption for physical is not your right. It's theirs. And that means the ETF's metal access is the center of the storm, not the ETF's ticker price. Show, simple diagram, retail buys/sells shares versus AP creates/redeems with metal. Let's walk through what creation units actually are, because this is where the entire $64 price lie begins. SLV shares are created in large blocks, creation units, typically a basket size like 50,000 shares. The exact number can vary by product structure over time, but the concept is the same: they're big institutional blocks, not one share at a time creations. When an authorized participant wants to create new SLV shares, they don't call a broker and click buy. They deliver a required amount of physical silver, according to the rules, standards, and bar lists defined by the trust, into the custody chain. In return, they receive that creation unit of shares, which they can then sell into the market. This is the glue that's supposed to bind paper share price to physical metal value. But notice the hidden assumption: the AP can always get the metal, move it through the system, and deliver it in the correct form, at the correct time, without the market seizing up. That assumption is the first crack. Because in a real shortage, the barrier isn't price discovery. The barrier is sourcing. If physical silver is tight, if large wholesale bars are spoken for, if lease rates are screaming, if refiners and vault networks are congested, then creation becomes hard, slow, or simply uneconomic. And when creation slows, the ETF can still trade, but it begins to trade as a closed loop of paper, investors trading shares with each other, rather than as a clean window into the physical market. This is what people mean when they whisper, the creation mechanism is freezing. Now I want to be precise with language, because the cartel loves ambiguity. A freeze does not have to be an official press release saying, we have halted creations. In fact, the most dangerous version is the unofficial one, when creations are technically available, but functionally clogged by reality. APs decide it's not worth the risk. Metal is available, but only at punitive premiums. The vaulting and delivery chain becomes a bottleneck. The trust's acceptable bar criteria becomes a constraint in a market full of mismatched supply. Borrowing physical to bridge the gap becomes too expensive. Settlement timeline stretch. Liquidity providers back away. You don't need a public shutdown. You only need AP behavior to change. Because APs are not charities. They are not there to protect retail investors. They are there to profit from spreads, when the system is stable, and to protect themselves, when it is not. So what happens when the system stops being stable? Two prices emerge. Price number one, the screen price, the one you see quoted around $64. Price number two, the access price, the price it costs to actually secure real metal in the size, form, and location required, without delay. And when those diverge, the entire premise of SLV equals silver starts to rot from the inside. This is why you must watch premiums and discounts. In ETF language, premium/discount is the gap between the market price of the shares and the net asset value of the underlying holdings. In calm markets, this gap is tiny because AP arbitrage snaps it back into line. But in stress, premium/discount is the alarm light. If SLV begins trading at a persistent premium, it can mean share demand is outstripping the ability, or willingness, of APs to create new shares by delivering metal. Investors are bidding up the paper claim because they believe it represents silver exposure, while the pipeline for turning demand into new metal-backed shares is constrained. If SLV begins trading at a persistent discount, it can mean something even darker. The market is pricing the shares as less trustworthy than the metal value they claim to represent. In other words, the market begins to haircut the paper. And here's the key point most channels won't say out loud. Both premium and discount can be bearish for confidence. Because either way, it signals that paper price tracking is breaking. It signals friction. It signals that the mechanism meant to keep SLV honest is no longer smoothly converting between paper and physical. Show, chart mockup, SLV price versus NAV with widening gap. Now let's talk about the word that should make you uncomfortable, prospectus. Most retail investors have never read the prospectus language of a commodity trust. They assume backed by silver means the same thing as redeemable for silver. It doesn't. The prospectus is where the product tells you, in polite legal language, what happens when the world turns ugly. This is where you'll see phrases like, the trust may face constraints sourcing metal. Market disruptions may impair operations. Authorized participants are not obligated to create or redeem. The trust can trade at a premium or discount. Custodians and sub-custodians may have limitations. Settlement delays, liquidity events, force majeure conditions. That language isn't there for decoration. It's a map of how the system fails. Because the ETF structure is not designed to guarantee you metal. It's designed to give institutions a tradable vehicle that usually tracks an underlying commodity, until it doesn't. And late 2025 is exactly the kind of environment where, until it doesn't, starts to matter. So when I say, creation units freeze plus the $64 price lie, I'm not claiming the ticker will stop trading tomorrow. ETFs can keep trading for a long time even when the underlying reality is deteriorating. That's the trick. That's how the paper market survives, it keeps you inside the paper loop. The lie is more subtle. The lie is that a price quote is proof of supply. A paper price can exist with zero deliverable metal at that price. A paper price can exist even when the physical market is paying a completely different number to clear real bars. A paper price can exist even when the arbitrage mechanism that is supposed to tether it to reality is slowing down or selectively functioning only for insiders. And once you understand that, you start asking the correct question. Not, is silver at $64? But, who can actually source silver at $64, in size, in the right form, delivered on time, without paying a hidden premium? Because the moment the answer becomes, only the right people, you're not looking at a market anymore. You're looking at a rationing system. And here's where the psychological trap is set. In a shortage, the public stampedes into the easiest instrument, the ETF. It feels liquid. It feels safe. It feels like, I got my exposure. But if the creation pipeline is constrained, the ETF becomes a pressure cooker. Demand piles into shares faster than new metal-backed shares can be created. Price dislocations form. Volatility spikes. And then, when stress peaks, the people with actual control, APs, market makers, institutions, decide whether they want to keep playing. That decision is not transparent to you. You will only see the symptoms, strange gaps, unusual premiums/discounts, sudden liquidity thinning, spreads widening, and tracking error that the mainstream will blame on normal volatility. No. It's not normal volatility. It's the paper market admitting, quietly, that physical is the constraint. So in this video, we are going to define what a real, creation/redemption slowdown looks like in practice, what metrics you can watch as early warning signals, how authorized participants behave when they smell delivery risk, and why the question, is there metal or not, is not conspiracy, it's the only question that matters in a commodity trust during a supply crisis. Because when the window closes, it doesn't close with a headline. It closes with silence, with spreads, with delays, with temporary dislocations that suddenly become the new normal. And if you're still trusting the $64 screen price as if it's proof of available silver, you are trusting the exact layer of the system that was built to absorb shock for everyone above you, by handing it to everyone below you.